Equity Market Update, May 2022. Indian equity markets declined in May 2022, and Nifty 50 and S&P BSE Sensex ended the month 3% and 2.6% lower respectively compared to a month ago. The key drivers of equity markets were concerns over accelerated pace of tightening by global central banks, elevated inflation, margin pressure due to high input prices, sustained selling by FPIs, uncertainty over Ukraine-Russia war, rate hike by RBI, etc. Large caps outperformed mid caps and small caps during the month. Sectoral performance was weak, and most major indices delivered negative month-on-month returns. Auto and consumer staples outperformed, while metal, power, healthcare and IT underperformed. Performance of major global equity indices was mixed, but better than the Indian indices. FPIs continued to remain net sellers in equities 8 months in a row and sold equities worth approximately $5.2 billion, following net selling of $2.2 billion in April 2022. On a cumulative basis, FPIs have sold equity worth $22 billion in 5 months CY22 compared to net buying of approximately $6 billion in the same period last year. FPI selling, to a certain extent, was balanced by strong buying by domestic mutual funds. Net inflows to mutual funds stood at approximately INR 24,700 crores in April 2022 and INR 121,000 crores approximately in 4 months CY22. For Q4 FY22, results of banks, NBFCs, auto and aviation were better than expected, while that of cement, utilities, telecom, oil and gas and infrastructure were in line with expectations. Results of consumer staples, pharma, IT, consumer durables and metals were below expectations. Outlook. As on 31st May 2022, Nifty 50 was trading approximately 17.5x FY24 E price to earnings ratio. While the price to earnings multiple is high compared to historical average, it should be viewed in context of steady economic recovery and healthy corporate earnings outlook. Again, the ratio of India's market cap to GDP based on CY23 eGDP is approximately 90%, that is, in the range of 60 to 100%, in which equity markets have been during most of the past 10 years. However, the gap between 10-year GSEC and 1-year forward Nifty 50 earning yield is higher than its long-term average. Further, corporate earnings growth is likely to normalize from FY23 onwards after seeing a robust improvement in FY22. On an overall basis, in our view, markets are no longer cheap. Despite recent correction, valuations of majority of sectors on aggregate basis is close to or higher than long-term averages. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in the near term. Outlook for the market is likely to be driven by expected growth in nominal GDP and corporate earnings growth. We remain positive on the economy and equity markets over the medium to long term on the back of domestic growth outlook, steady corporate profitability, growth-oriented policies, etc., accelerated monetary tightening, sharp increase in US yields, elevated inflation, adverse impact of Russia-Ukraine war on growth and commodity prices, slowdown in China, FPI outflows, etc. are likely to be key near-term headwinds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.